Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things. Rule number 1, never lose money. Rule number 2, never forget rule number 1. If you're emotional about investment, you're not going to do well. You may have all these feelings about the stock. The stock has no feelings about you.
Changes at the top.
Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless. I like businesses I can understand. We'll start with that. That narrows it down about 90%. I mean, there's all kinds of things I don't understand, but fortunately, there's enough I do understand. And you got this big, wide world out there. Almost every company's publicly owned, so you got all American business practically available to you. Now, to start with, it doesn't make sense to go with things that you think you can understand, but you can understand some things. I can understand this. I mean, you can understand this. Anybody can understand this. I mean, this is a product that basically hasn't been changed much. They've added the cherry, but since 1886 or whatever it was, and it's a simple business. It's not an easy business. I don't want a business that's easy for competitors. So I want a business with a moat around it. I want a very valuable castle in the middle, and then I want the duke who's in charge of that castle to be honest and hardworking and able. And then I want a big moat around the castle. And that moat can be various things. The moat in a business like our auto insurance business at GEICO is low cost. I mean, people have to buy auto insurance. So everybody's going to have one auto insurance policy per car, basically, or per driver. And I can't sell them 20, but they have to buy one. What are they going to buy it on? They're going to buy it based on service and cost. Most people will assume the service is fairly identical among companies or close enough. So they're going to do it on cost. So I got to be the low-cost producer. That's my moat. To the extent my costs get further lower than the other guy, I've thrown a couple of sharks into the moat. But all the time, if you've got a wonderful castle, there are people out there who are going to try and attack it and take it away from you. And I want a castle that I can understand, but I want a castle with a moat around it. 30 years ago, Eastman Kodak's moat was just as wide as Coca-Cola's moat. I mean, if you were going to take a picture of your 6-month-old baby, and you're going to want to look at that picture 20 years from now, and you're going to want to look at it 50 years from now, and you're never going to get a chance. I mean, you're not a professional photographer so that you can evaluate what's going to look good 20 or 50 years ago. What is in your mind about that photography company is what counts, because they are promising you that the picture you take today is going to be terrific to look at 20 or 30 or 50 years from now about something that's very important to you, maybe your own child or whatever it may be. Well, Kodak had that in spades 30 years ago. They owned that. They had what I call share of mind. Forget about share of market, share of mind. They had something in everybody's mind around the country, around the world, with a little yellow box and everything, that said Kodak is the best. That's priceless. They've lost some of that. They haven't lost it all, and not due to George Fisher, who runs it. George is doing a great job. But they let that moat narrow. They let Fuji come and start narrowing the moat in various ways. They let them get into the Olympics and take away that special aspect that only Kodak was fit to photograph the Olympics. So Fuji gets there, and immediately in people's minds, Fuji becomes more and a parody with Kodak. You haven't seen that with Coke. Coke's moat is wider now than it was 30 years ago. You can't see the moat day by day, but every time the infrastructure gets built in some country that isn't yet profitable for Coke but will be 20 years from now, the moat is widening a little bit. Things are all the time changing that moat in one direction or another. 10 years from now, you can see the difference. Our managers of the businesses we run, I've got one message to them, which is to widen the moat. And we want to throw crocodiles and sharks and everything else, gators, I guess, into the moat to keep away competitors. And that comes about through service. It comes about through quality of product. It comes about through cost. It comes about sometimes through patents. It comes about through real estate location. So that's the business I'm looking for. Now, what kind of businesses am I going to find like that? Well, I'm going to find them in simple products, because I'm not going to be able to figure out what the moat's going to look like for Oracle or Lotus or Microsoft 10 years from now. I mean, Gates is the best businessman I've ever run into, and they've got a hell of a position. But I really don't know what that business is going to look like 10 years from now, and I certainly don't know what his competitors' businesses are going to look like 10 years from now. Now, I'll name one I don't own. I know what the chewing gum business is going to look like from 10 years from now. I mean, the internet is not going to change how we chew gum, and nothing much else is going to change how we chew gum. And then are there going to be lots of new products? Is it really, are spearmint and juicy fruit and all those going to evaporate? So it isn't going to happen. You give me $1 billion and tell me to go in the chewing gum business and try and make a real dent in Wrigley's, I can't do it. And that's the way I think about business. I say to myself, give me $1 billion and how much can I hurt the guy? Give me $10 billion. Give me $10 billion and how much can I hurt Coca-Cola around the world? I can't do it. Well, those are good businesses. Now give me some money and tell me to hurt somebody in some other fields and I can figure out how to do it. So I want a simple business, easy to understand, great economics now, honest and able management, and then I can see about, in a general way, where they're going to be 10 years from now. And if I can't see where they're going to be 10 years from now, I don't want to buy it. Basically, I don't want to buy any stock where if they close the New York Stock Exchange tomorrow for 5 years, I won't be happy owning it. I buy a farm, and I don't get a quote on it for 5 years, and I'm happy if the farm does okay. I buy an apartment house, don't get a quote on it for 5 years, I'm happy if the apartment house produces the returns that I expect. But people buy a stock, and they look at the price the next morning, and they decide whether they're doing well or not doing well. It's crazy, because they're buying a piece of a business. That's what Graham, the most fundamental part of what he taught me. You're not buying a stock, you're buying a part ownership in a business. You will do well if the business does well, and if you didn't pay a totally silly price. And that's what it's all about. And you ought to buy businesses you understand. Just like if you're buying farms, you ought to buy farms you understand. It's not complicated. In calling this Graham Buffett, I mean, it's just pure Graham. I was very fortunate because I picked up a book when I was 19. I got interest in stocks when I was about 6 or 7, and I bought my first stock when I was 11, but I was playing around with all this stuff, and I had charts.
Charlie Munger has had a big impact on me in moving me toward looking for wonderful companies at fair prices rather than fair companies at wonderful prices. And that was enormously important because it enabled Berkshire to scale up in a way that would have been impossible to do otherwise.
Don't think is terribly important. I think if you're interested in the stocks, you should buy it. And you've got a little capital, you should buy a few. I mean, I don't think there's any way of learning about them better than experiencing it. Doing it on paper isn't the same. I can guarantee you, if you lose money on paper or lose real money, it's a different experience. And so I think you'll learn more about yourself if you do it that way. I bought my first stock when I was 11. I was at Rose Hill at the time, and I bought 3 shares of City Service Preferred at 38, and it went down to 27, which is something I still remember, even though I was 11 at the time. And then it went up to 40, and I sold it. I made $5 on my 3 shares after commissions, and then it went to 200 and something. So, I probably remember that a little better than if I'd been doing it on paper. And I fooled around doing a lot of things between about age 11 and 19 in the stock market. I did charts, I did all kinds of technical analysis, I read every book I could get on the subject, and I didn't do that well. I didn't do terrible, but I was really just floundering around. But that meant by the age of 19, when I read Ben Graham's book, I was at the University of Nebraska in Lincoln, I went and bought this book called The Intelligent Investor, just come out, and it had an enormous impact on me. Now, if I hadn't done, in the previous 8 years, if I hadn't been all over the lot, I'm not so sure that book would have had the same impact on me. I mean, by that time, I was prepared to read Ben Graham's book, which changed my life financially in an incredible way. I mean, I wouldn't be up here today if I hadn't read that book. But yeah, part of life is getting prepared so that when something does happen that's significant, you can grasp the significance of it and know what to do with it. And I would say that first 8 years of fooling around, even though it produced nothing financially to speak of, produced a lot in terms of getting my mind prepared for when I really did read something that made sense. And so I was ready to accept it. And I actually went back and went to Columbia to study under Graham, and because of reading that book, and all kinds of things flowed out of it. So I would encourage you, if you're interested in the field, to to do a few things. I'd still try and make them as intelligent as possible. I would try to stick with things, businesses I thought I understood. I'd still get out that sheet of paper and I'd write, I'm doing this because, and just test my reasoning. And then I'd go back and read it a year later and see whether what you thought would be true turned out to be true. So I would always check myself. I believe in grading myself on everything. You know, doctors have postmortems, and they do it because they learn from postmortems. In business, people don't like to do postmortems. When I can be on the board of a company, and they can dollars building plants or buying companies, and they never wanted 2 years later to run a check on how that decision turned out because it can be unpleasant. But you learn from postmortems, and you don't want to learn. It's way better to learn from other people's mistakes than your own, but you got to learn from a few of your own too. And the time to do it is when you're young. Those are low return businesses. But time is the friend of the wonderful business. It's the enemy of the lousy business. If you're in a lousy business for a long time, you're going to get a lousy result, even if you buy it cheap. If you're in a wonderful business for a long time, even if you pay a little too much going in, you're going to get a wonderful result if you stay in a long time. If you take John Meriwether and Eric Rosenfeld, Larry Hillenbrand, Greg Hawkins, Victor Agani, the 2 Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country, including at Microsoft or wherever you want to name. So there's an incredible amount of intellect in that room. Now you combine that with the fact that those 16 had extensive experience in the field they were operating. I mean, this was not a bunch of guys who had made their money, you know, selling men's clothing and then all of a sudden went into the securities business or anything. They'd had in aggregate, the 16 had probably had 350 or 400 years of experience doing exactly what they were doing. And then you throw in the third factor, that most of them had virtually all of their very substantial net worths in the business. So they had their own money up, hundreds and hundreds of millions of dollars of their own money up, super high intellect, working in a field they knew, and essentially they went broke. And that to me is absolutely fascinating. I mean, if I ever write a book, it's going to be called Why Smart People Do Dumb Things. My partner says it should be autobiographical, but but this might be an interesting illustration. And these are perfectly decent guys. I respect them, and they helped me out when I had problems with Solomon, and so they're not bad people at all. But to make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You know, you can name any sum you want, but it doesn't do anything for me on the upside, and I think the downside's fairly clear. So I'm not interested in that kind of a game, and yet people do it financially and without thinking about it very much. There was a great book. It wasn't a great book. It was a great title. There was a lousy book written once with a great title by Walter Gutman. The title was You Only Have to Get Rich Once. Now, that seems pretty fundamental, doesn't it? What difference if you've got $100 million at the start of the year and you're going to make 10% if you're unleveraged and 20% if you're leveraged 99 times out of 100? What difference does it make at the end of the year whether you've got 110 million or 120 million? It makes no difference at all. I mean, if you die at the end of the year, you know, the guy that writes up the story may make a typo and he may say 110 even if he had 120. So you've got nothing at all. You know, it makes absolutely no difference. It makes no difference to your family. It makes no difference to anything. And yet the downside, particularly managing other people's money, is not only losing all your money, but it's disgrace and humiliation and facing friends whose money you've lost and everything. I just can't imagine an equation that makes sense for. And yet 16 guys with very high IQs who are very decent people entered into that game. And, you know, I think it's madness. And it's produced by an over-reliance to some extent on things. You know, those guys would tell me back when I was at Solomon, you know, that a 6 sigma event wouldn't touch us, or a 7 sigma event, but they were wrong. I mean, their history does not tell you the probabilities of future financial things happening. And they had a great reliance on mathematics, and they felt that the beta of the stock told you something about the risk of a stock. It doesn't tell you a damn thing about the risk of a stock, in my view. And sigmas do not tell you about the risk of going broke, in my view, and maybe in their view now too. But I don't like to even use them as an example, because they are. I mean, the same thing in a different way could happen to any of us, probably, where we really have a blind spot about something that's crucial because we know a whole lot about something else. It's like Henry Kaufman said the other day. He said the people who are going broke in this situation are just two types: the ones who knew nothing and the ones that knew everything. And it's sad in a way. I urge you, in anything. We never basically borrow money. I mean, we get float through our insurance business and to do things. But I never borrowed money. I never borrowed money when I had $10,000 basically, because what difference did it make? I was having fun as I went along, and it didn't make any difference whether I had $10,000 or $1 million or $10 million. Except if I had a medical emergency or something had come along like that. But I was going to.
Credit card debt is something you bring on yourself, and it's way better. It's way easier to stay out of trouble than to get out of trouble financially. And I will guarantee you, if you run up big credit card debts, you will be in trouble probably the rest of your life in terms of your financial situation. On the other hand, if you get ahead of the game, even it's on a very modest scale, so that money is coming in from investing, and people owe you money or equities owe you ownership, you'll be way ahead of the game compared to paying it. Always paying your creditors every month. So my advice to you is, if you can't pay for it, don't buy it, and get yourself in a position where you can pay for anything. And then we'll be glad to see you at Borsheim's or the Nebraska Furniture Mart. Now let's